Okay, good morning, everyone. I think that we will get started now. There may be a few people who are trickling in. As you noticed, we're taking our seminar in English today as we have some external or outside of Sweden participants that we are very excited about. Welcome to this SEPREF's third annual seminar, where we are discussing the trends that we expect during the year ahead. And it's especially interesting given this sunny and now restriction-free Sweden that we are living in. So it's nice to see so many participants today. And I'm not going to keep my welcome long, but I'm going to hand over now to Jon Lekander, who is going to be the moderator for our seminar. Thank you, Jon.
Thank you very much, Tiffany. Once again, welcome everyone. The topic of today is the year ahead, and we will start with a broad European outlook presented by Andreas Trumpp from Savills Investment Management, and then we will drill a bit more into the Swedish market, where Arvid Lindqvist from Catella will give the Catella house view on the Swedish property market. And then we'll end with Karen Vitalis, who will present the SEPREF consensus forecast, i.e. what we in the industry expect of the market in the short term. With those words, I'll hand over to you, Andreas.
Thank you very much, Jon, for the introduction. I will now share my screen, and if someone could let me know if you can see the slides, I'd be very happy.
We can see your slides. Thank you.
Fantastic. Yeah, thank you very much, and good morning again from a still from a Germany which is still in restrictions. So greetings to you in Sweden. I hope we will follow your path very, very soon. So during the next 20 minutes, I would like to run through our house view on the European real estate markets. And as usual, we should quickly have a look on the economy. And COVID continues to dictate the economic recoveries. However, the fundamentals for the real estate markets are positive in our opinion. Global economies such as the US or China, they have already returned to their pre-pandemic levels in early 2021. And the major European economies either have already or will follow shortly, something you can see on the left-hand side. What is important in our view is that consumers are willing to spend pent-up money, which is why the current recovery was mainly consumer-driven. Furthermore, also a very important point in our opinion, the European labor market has recovered well, although there's certainly still a way to go in individual countries. However, and overall, we expect to see a continued employment growth in this year in the Eurozone and in the UK. And then we certainly have to discuss about an elephant in the room. It's rising inflation. So there has been a lot of noise around rising inflation during the past 6 or 7 months, and investors have this topic on top of their agendas. According to an investor survey we recently conducted for our Outlook report. Please have a look on the chart on the left-hand side. Generally, the Eurozone inflation should have peaked, hopefully in January this year. Excuse me. There are base and reweighting effects that should bring rates down early in the current year. And in addition, energy inflation is also expected to drop notably over the course of this year. And bringing this all together, however, means that the times of ultra low interest rates and government bond yields could be over in the mid-time. That's one of our expectations and something you can see on the chart on the right-hand side. While both interest rates and government bond yields are forecast to remain at historically still low levels, effects on financing are foreseeable, with corresponding consequences for net initial yields. Just as an example, the 5-year euro swap rates, which had been negative for roughly 2.5 years, are back in positive territories. And if you look into the UK, for example, the 5-year British pound swap rates climbed by more than 120 basis points during the last 12 months. So quite obvious that there will be some impact on the real estate markets. In this context, I would also like to highlight that what drives inflation matters for real estate. So if driven by a strong economic growth, property tends to benefit from the cyclical upswing. In contrast, short periods of supply shock inflation tend to have rather limited impacts. The issue is that raising interest rates in the near term is unlikely to control the current rather supply side driven inflation, but could dampen the economic recovery. And the economic recovery is currently forecast to be at a strong around 4% for both the US and the Eurozone. So although this doesn't sound too positive for real estate, we also need to bear in mind the traditional fixed income returns, you can still see them on the right-hand side, are still at or close to all-time lows, and equity markets valuations are still very high. And in this context, real estate continues to combine some positive factors, stable cash flows, diversification, and a certain protection against inflation risks. In addition, rising construction costs and capex could have a potential medium-term upside in slowing development, thereby supporting rental value growth, particularly in markets where there already is a shortage of supply. Just think about the industrial and logistics market. So it's not only inflation, there's also another elephant in the room. So the room is quite full at the moment. It's ESG. Ever more ESG and sustainability is forming a key part of decision-making processes across all areas of commercial real estate markets. And Savills IM's own target is to halve emissions by 2030 compared to 2019 and achieve net zero emissions by 2040. And as businesses increasingly think about the sustainability angle of real estate, this is changing the type of assets investors are prepared to buy and also their risk return profiles, which will have implications for property values in the future. And our investor survey underscores this. The chart on the left-hand side shows that close to 1 in 3 investors expect sustainability issues to have a significant impact on their investment strategies, while roughly half of respondents expect it to have moderate impact. And if we turn the result around the other way, only about 1 in 5 respondents don't believe that climate risks will have much of an impact on their investment decisions. So with climate due diligence increasingly incorporated into investment decisions and assets now being ruled out on ESG and sustainability grounds, the direction of travel is clear. Moreover, investors, and that's something we also found in our survey, are prepared to put their money where their mouth is. The chart on the right-hand side shows the extent to which investors would be prepared to sacrifice short-term returns for the long-term stability of the assets. And 1 in 3 investors say that they would be prepared to give up to 50 basis points or half of 1% of returns to ensure the future stability of their assets. And more impressively, that's why I've highlighted it in light blue, 44% of the survey respondents said they would sacrifice up to 1% of their returns. So overall, more than 90% of respondents would be prepared to forego some short-term return to achieve long-term sustainability goals. We found that quite impressive. So looking at the investment markets and looking ahead, we can say that there is no shortage of capital looking to be invested into European real estate. Just have a look on the chart on the left-hand side. As we can see from this chart, Preqin estimates that there is still roughly 65 billion of US dollars of dry powder wanting to find a home in European real estate markets. And this is only focusing on the four traditional investment styles. So core plus, value add, and opportunistic strategies. And it is obvious that the challenge is where to invest this money. Since the significant yield compression we have seen during the past 5 years will most likely not continue during the next 5 years, markets might be at a turning point with lower overall capital value growth. If you look on the chart on the right-hand side, please note that this analysis is always focused on prime assets only. The situation could certainly look completely different on an asset level. Something I just wanted to mention because it's very important that we rather look at the prime end of the market or at the averages. So individual assets could look differently. But what we can see in the chart on the right-hand side is that office and logistics capital value growth is forecast to be lower in the next 5-year period than during the 2017 to 21 period. On the other hand, capital value growth for retail assets could finally return to positive territories. So although this again might not sound too positive, we have to be realistic. We are still in a global pandemic, and uncertainty is still high. Nevertheless, we can see glimmers of hope, and we believe that things will improve notably from now. And you are just experiencing that in Sweden, I guess. So the real estate markets are usually lagging behind a little bit. In other words, it might take some time before improvements can be seen in the wider markets. And with that, I would quickly like to turn to the occupier markets. There is still a lot of debate about the future of the office, and almost everyone has an opinion on it. And as you can maybe see from the background, I am in the office today. So what I would like to say is that how this will play out exactly, nobody knows just yet. And there will undoubtedly be regional differences depending on the country, the city you are based. But working from home, along with other structural changes, will impact occupier demand over the next 10 years. It will also affect the type of space occupiers let. And this will challenge CapEx assumptions and requirements to reconfigure office space that provides more flexible space options that meets changing demands from occupiers. Pressure is also coming from climate change and ESG policies, something we've already discussed about. The majority of existing stock does not yet have a green label, but given the direction of travel around climate risks, Sustainability and ESG, as I have already mentioned on the chart earlier, increasingly are because of that, investors are increasingly prepared to pay a premium for green labeled buildings to ensure the future resilience of the assets. So what we've seen in the survey is something we can also observe on the markets. Please have a look on the chart on the left-hand side. Of course, it is more expensive to build a green building, but there is also a significant difference in the rents achieved according to BREEAM labels, something you can see on the right-hand side. And research also suggests that occupiers are prepared to pay higher rents for the best space. What we expect is a clear differentiation in the performance of the best space compared to the rest. While the office isn't dead, the risk profile is certainly changing, and investors need to be aware of this situation. Moving on to the industrial markets, there are certainly some key messages for this sector. What we expect is another year of outperformance. Occupier and supply side fundamentals are still intact. Take-up volumes held very strong on the back of secular demand drivers such as e-commerce and cold storage, but also due to the ongoing recovery of manufacturing and logistics, the overall logistics sector in the wake of the economic recovery. So the demand side is intact and the supply side is as well. Vacancy rates are still very low and land scarcity is holding down supply across Europe. And there's also a double catch-up process at capital markets, which is still continuing. And believe it or not, there are still new investors and investment managers doing first-time investments in the sector. And at the same time, there is still an under allocation in existing portfolios, and investors adjust their quotas towards industrial at the cost, for example, of retail or offices. Second thing, thematic investment becomes a mainstream. So capital raising and investment or sentiment has never been stronger for industrial and logistics. Just have a look on the right-hand side. The INREF investment intention survey from this year revealed that industrial is the highest preferred sector across Europe for 2022. And the story around the sector's strength has been told multiple times now. I've already mentioned it with regards to demand and supply. We observe a lower priority of locational or specific geographical strategies in this context. Third thing I would like to mention, the overall risk return profile remains attractive given the economic tailwinds and market fundamentals. But fourth thing I would like to mention, the sector is coming of age and risks are emerging. So reletting risks around ESG and also technological future-proof or proofness beyond the initial lease term have to be mentioned here. And price and yields appear very stretched, something we can see across Europe. The yield compression accelerated in almost all markets across Europe, also in peripheral countries. It's not only the core markets, it's also the peripheral countries. Whilst rental growth is rather flat or ERV assumptions appear to be priced in already. Quick summary here. We still see a strong case for logistics and particularly alternative formats in higher yielding core plus and mid-box segments and opportunities up the risk curve. Moving on to retail, and well, not much good can be said of the COVID-19 pandemic, but it has reinforced the resilience of grocery retail to changes in the economic backdrop, not least because we all need to eat. While the negative impact of lockdowns on fashion retailers, I've just taken fashion as an example, is clear. Grocery sales continued to rise, supported by restrictions on going out. More importantly, something you can see on the chart on the left-hand side, this chart emphasizes the greater stability in grocery sales compared to the likes of fashion or other sectors, even before the pandemic. We think that the pandemic has also highlighted the defensive qualities of retail parks as a shopping format, not necessarily for the experience, but rather for their accessibilities and types of goods on offer. And retail parks also tend to benefit from an anchor supermarket tenant in or next to the park, which then helps to drive footfall. For sure, retail parks haven't been immune from the, let's say, wider downturn in the retail sector with significant rental and capital value declines in recent years, particularly in the UK. However, the worst now appears to be behind us. Let's also have a quick look on the living sector, so on residential. The population of Europe has been growing over the last years, and this is particularly true for major cities in Europe. And the outlook in the midterm is also positive. So growth will continue in many geographies over the coming years. More important for the real estate markets, the number of households has been increasing even faster, fueling demand, particularly for smaller apartments, so 1 or 2 bedrooms apartments in cities. And at the same time, we see the opposite trend is going on regarding the building permits that have been issued for apartments. In other words, supply could not keep pace with demand. And this means that there is a backlog in the housing stock to provide all households with an appropriate apartment. Affordability is also an issue. So people cannot buy their own apartments any longer, afford them. This is an issue, and this is driving the rental markets, which is something we are monitoring very, very closely. Let's bring this all together on my last slide. As mentioned, ESG is a game changer for the real estate industry and will dominate the discussions this year. I think this is set in stone. If we look at industrial and logistics, we continue to see the compelling value in buying and creating modern, flexible, multi-let core plus logistics and industrial facilities in the key European logistics hubs. However, something I hopefully could make clear, we strongly believe that the mid-box segments, such as urban last mile logistics, light industrial estates, cold storage subsectors, and the likes, offer compelling opportunities for portfolio diversification and higher risk-adjusted returns. Living, something I covered on my last slide, the European living sector also comes of age. Everyone needs a home and they typically want more space. We believe that the living sector is underpinned by demand and supply imbalances, and that scalable, operationally light segments, multifamily, PBSA, and the likes look the most attractive to us. Well, the comeback of the European office sector will be based on the further development of the pandemic, the strength of the economic recovery, any improvements of occupier fundamentals, and the return of liquidity. There will most likely be a polarization between future-proof assets and the rest, something that is also connected to ESG. Income streams will be less secure as tenants demand more flexibility and increased fit-out costs. Last but not least, retail. you've heard it, we continue to see selective investment opportunities in European retail. We continue to like daily goods, grocery retail formats, as well as larger food-anchored retail parks in European areas, urban areas. We think that investors should also consider strong income-producing opportunities in, let's say, the value and convenience retail park segments, retail warehouses in strong micro locations. I know I have run a little bit over, but with that, I'm at the end of my presentation. Thank you very much.
Thank you very much, Andreas. A quick question to you. When looking at Europe from sort of afar, where do you see sort of the interesting hotspots in broad sense? And how does Sweden pair up with sort of the European overall picture? Do you have any thoughts or comments on that?
Yeah, I mean, I would like to answer this question from a really top-down perspective. I think Sweden has very strong economic fundamentals. Let's say, most interesting real estate markets are certainly focused on only a handful of cities. Stockholm is the obvious one, and maybe 2 or 3 other regional cities. And it always depends on what kind of investor you are and what kind of product you are looking for. I think offices is something that is for core investors, core plus investors, most likely interesting in Stockholm only. Retail parks, maybe 1 or 2 shopping centers is something you can widen, let's say, the geographical focus, and logistics. I mean, the golden triangle, I think it is called, in the south of Sweden, is certainly or are certainly the most preferred areas, at least for us as a core investor. And for sure, something I've mentioned as well, urban and last mile logistics is something that is very attractive in almost all major conurbations in Sweden, but certainly also in the rest of Europe and the UK.
Thank you very much, Andreas. So that gives sort of the backdrop and some thoughts on sort of Europe and what the main trends are in Europe. I'll now hand over to Arvid, and please take us through how big the damage has been for Sweden and what the outlook is.
Do you see the slide, Jon?
Yes, I do.
Yeah, excellent. Then let's start off. Well, this is a scary snake. This is the front page of our most recent quarterly market forecast that we do at Catella. I'm by the way, research at Catella, and we have this research club with around 35 members, the most large investors on the Swedish market that are in the research club, and we do this quarterly kind of market forecast. And this, on the latest forecast, we had this snake. It's a rattlesnake called the snake, and it's a little bit try to have some front pages that say something about market and market outlook and so on. And in this case, I mean, it's referring, of course, to Pyrrhus, the old Greek king from the 270s before Christ, that made lots of war and successful war against Romans, but also made a number of victories that were very expensive or very hard fought and hard won for Pyrrhus, and famously said that one more victory like this and the war is lost, or something like that, according to the myth. And we are kind of referring this to the development we see now. I mean, with now the latest string of coronavirus, it seems like the pandemic is about to end. I mean, today actually we are taking away all restrictions in Sweden, and same happened in Denmark like a week ago, something, and so on. And most likely we're going from a pandemic to an endemic now, and we'll have more of a open and kind of normal societies from now on, although this virus will of course keep on affecting us, and new strings will most likely return. But anyway, I mean, the previous victory, I mean, it seems like we won to some extent, but at the same time, it was at a very high cost. And the question is, what will happen now when we end towards the next recession? We will have any muscles when it comes to fiscal and monetary stimulations and so on? We will have any dry powder left to actually take us out of the next slump? That's the big question. And also, it's a very interesting question because now, I mean, the inflation has come, and that is a big change towards what we've seen over the last decades. But pretty much, I mean, Catella, we have a number of forward-looking indicators, a mix of kind of macro indicators that are leading for GDP on the left-hand side and for the CPI inflation on the right-hand side on this graph. And basically, it's a combination for GDP. It's a combination of the equity market and a number of other macro interest rates and a number of other macro factors that are kind of leading, and works very good over time. And what this says about the economy is that we are peaking. We are peaking about last year, pretty much, and the growth is slowing down now, but still stand at high levels, approximately 4% year over year or something. If we look at that indicator at the moment, and that will slow down a little bit towards the first half this year, but still remain at high levels, historically very high levels of growth. At the same time, we're seeing that inflation on the right-hand side has really soared, but also that in the short term seems to slow down, and very much driven by lower year-on-year growth rate on commodities to a large extent, because this indicator is basically a mix of approximately 10 commodities and currencies. I mean, we'll probably see a slowdown from today's level of approximately 4% towards 2% or something. But on the long term, and this is a scenario that we have had at Catella for several years, all the way back to 2019, actually, that we see a more secular inflation coming. And that has very much to do with the high debt levels in the global economy, as we see, combined with less globalization, basically. I mean, we believe that one of few ways to handle the high debt levels that we currently have is moving towards higher inflation and try to inflate away the debts. And that is a view we have for a number of years, and it seems like this view is playing out. And it seems like the coronavirus was the kind of trigger for that scenario. We always know that probably the next recession, we said in 2019, will probably be a trigger towards a movement towards inflationary policy. And it seems like the corona was that trigger. And it seems like although in the short term inflation will fall back, we'll most likely end up in a gradually increasing inflation environment, where inflation will move along up and down along a gradually increasing trend for a number of years until the next recession. Well, looking into the listed companies, I mean, in Sweden we have lots of listed companies, approximately 40, and they are a good liquid market and a good way of looking into how the market think about real estate and the property sector, because I mean this is the best way of have a daily pricing of Swedish property, actually. And on the left-hand side, we have grouped these companies into different subgroups depending on what sectors really they are focusing on. And what we see there basically is that we are currently in a kind of a heavy correction when it comes to the listed equity companies, and we are done. I mean, this is a week or so old, these figures, but we approximately, I mean, the drop have stabilized a little bit, but we are done like 17% or something for the average for all companies in 2022 year to date. And I mean, the largest drop has been in these most popular segments when you look into industrial logistic properties and residential and the public property companies focusing on these segments. But also, I mean, the yellow line is the companies focusing on offices and retail companies, and they have really underperformed throughout the pandemic, but they have had quite a sharp drop as well. So it's kind of all over the line. That the market have been a little bit more skeptical to real estate, skeptical to property sector since the all-time peak that we hit in late November. And the background to this is, of course, quite a significantly increase in real interest rates that we've seen over the last month. and that is not good at all for property, and we'll see more about this later on. But I mean, one important factor driving asset prices in general and the Swedish property market is, of course, monetary stimuli. And in this case, I mean, the monetary stimuli, you cannot look only at the Riksbank. I mean, this is global, and the capital flows are global, and you need to look more broader than kind of the Swedish Riksbank. The Swedish Riksbank is only basically following the main and large central banks are doing. And I mean, in this case, we have had 6 major central banks, including Fed, the ECB, Bank of England, People Bank of China, Bank of Japan, and also had the Riksbank, and look into their balance sheet. And this is very interesting because, I mean, the central banks really expanded the balance sheet of the Corona crisis. I mean, they hit the peak. You can see on the left-hand side graph. I mean, we have worked with the quantitative easing way of stimulating the economy basically since the financial crisis, but and the year-on-year growth rate have been between approximately 0 and $2 trillion year-on-year. Most of the time, pretty much between $1 and $2 trillion in growth rate. But we saw a tapering just before the Corona. But when the Corona hit, we saw that the major central bank just increased the balance sheet significantly, and combined that, of course, with a major fiscal stimulus, and this was very efficient in keeping up growth rates. So the drop in growth and the recession was very, at least in the Western world, was very short. In Sweden, extremely short. It was hardly a real recession at all, actually. And I mean, they peaked at almost 10 trillion year-on-year growth rate. So that's just enormous figure. That was, I mean, the 12 months after, from February 2020 and 12 months ahead, I mean, the combined balance sheet grew with equal amount to the following the previous 10 years. So it's just a massive expansion of the balance sheet. But that is drawing down now, and we see that most large central banks have announced or have already started to taper and slow down their asset purchases. And the market is speculating now, because we have high inflation. They speculated that we will see rate increases, and we will see even reductions of the balance sheet going forward. And that is what's scaring the market, really. In mid-size graph, you can see how well the equity market is responding to these balance sheets. I mean, it's all about liquidity. When you increase the balance sheet this much, you reduce interest-bearing debt, interest-bearing very safe debt from the market, which bought by the central bank. And they basically pay with central bank reserve, which has no yield at all, and that forces investor out of the risk scale and into the equity market and into property and so on. And it's very beneficial for asset prices. And so I mean, with a background with increasing balance sheet, the blue line there is Standard & Poor's 500. It's hard to see that the equity market and the asset prices would go anywhere than they have gone, extremely up based on all the liquidity out of the market. In the right-hand graph there, you can see Swedish logistic yields, and yields is inverted yields, and that is a proxy, of course, for prices for Swedish logistic on the Swedish logistic market. And what we've done is that we have taken rolling 12 months yields from Swedish industrial logistic transactions, really. But what we see in here is it's a gap. I mean, they follow quite good, this balance sheet and the yields, looking from 2013 and onwards. But since the Corona, I mean, all the money that flowed into equity prices, the effect has not been that effective in the property market as it has been on the equity market. And that is also one background to the high premiums that we had. I mean, more money have flown into the more liquid market, and the real assets haven't been able to keep up in the pace. And that's also because the liquid markets are leading indicator to the real assets. So what we see basically now is a continuous pressure downwards at yield and upwards at prices on the property market. And the logistic industrial sector is just a very popular segment, that a good way of painting this picture, really. And all about, I mean, real interest. It's all about real interest, and that is the factor why we see dropping equity prices for listed companies currently. I mean, we are probably already in a long-term scenario with gradually increasing nominal interest rates. It's faster. Left-hand side graph, you can see it faster in the US than in Sweden. But what's really important here is the mid graph, which is the long-term 30-year real interest rates in the US, and US kind of benchmark for the whole of the world. So it's interesting to look at the US real interest rates as kind of a proxy for the global real interest rate. And this is the 30-year US TIPS rate, which is inflation-linked bonds, really. So it's a good proxy for long-term markets, long-term view of the real interest rates. And what we've seen really since late November is a massive increase in the long-term real interest rates. I mean, we've gone from almost minus 50 basis points to above zero now. I mean, this is a few weeks old graph, so a little bit above zero. And looking back a little bit, we saw that we had a period of a number of years up until 2019 where the long-term interest rates fluctuated around 100 basis points. And in 2019, I mean, this flow into property, massive flow, started already before the corona. It started in 2019, and it started when the long-term real interest rate dropped from approximately 100 basis points to 50 basis points. We saw massive inflow capital into property, Swedish and foreign capital, and we saw massive flow. Offices were very popular at this point, but also logistic, industrial, residential, and public properties, and so on. And then came the corona, and the long-term real interest rate dropped even more. It dropped from plus 50 basis points to minus 50 basis points, basically, over a number of quarters. And that was just a massive injection into the property market yields. I mean, the blue line here is basically rolling 12 months average residential yields on the Swedish property market, and they follow this long-term real interest rates very thoroughly. And yields just dropped based on these lower real interest rates. And then what we see now is that these long-term interest rates start to increase, and then of course that put really a lid on the development on the property market, and that will most likely push up yield levels a little bit over the coming months. However, I mean, what's interesting is that I mean, on the right-hand side graph, you can really see inflation in the US combined to inflation expectations. What you can see, basically, the red line is inflation expectations, and they over the coming 10 years, and they have not increased. So it's almost only the real interest rates that increased here. And some people are saying that this is because a market expects stronger growth and a stable inflation going forward. I think that is a very unlikely explanation for this. I think that the most likely explanation is that the Fed is the single largest buyer of these TIPS, on this TIPS market. And when the Fed announced that they will reduce the purchases and even sell off bonds, that, of course, affects pricing in the bond market. So I don't think that the long-term real interest is a good proxy of kind of growth ahead. I think it's more about the dynamics on the market, and that the biggest buyer is actually starting to sell, and the biggest owner will probably sell going forward. And that, of course, impacts real interest rate, and that impacts asset prices all over the world, basically. I mean, what we see also now is that credit spreads are bottoming out. In the left-hand side graph here, you can see U.S. corporate spreads between high and low-rated U.S. bond corporate bonds. Really, they are at very low levels, and they've increased slightly over the last months, but not very much. And on the right-hand side, you can see the blue line, which is the average spreads for the biggest listed Swedish companies. It's 13 or 14 of the biggest companies that we just paid the average spread. And what we see is that the average spread is bottoming out in late 2021, early 2022. And the average spread is, of course, is an average. So it's I mean, when spot spreads increase, average spreads can still decline for a number of quarters. But what we see now is a bottoming out, and when we see more or less monetary stimuli, we would like to see spreads increase, credit spreads increase too. And we have already seen this on the Swedish property market and Swedish credit market. Spreads are starting to go apart. So looking ahead, I mean, what we see is we are most likely moving towards an inflation scenario, and most likely actually a stagflation scenario, because we will have high inflation, and basically because it's unsync between the financial and the real economy. And it's very important to remember this unsync. I mean, in Sweden, we approximately have a nominal growth rate of approximately 8%, a real growth rate of approximately 4%, and inflation rate of 4%. In the US, we have a nominal growth rate of about 9%. And the nominal growth rate should over time be quite equal to the short interest rate environment. And the short-term interest rates approximately, or they've increased a lot, but they are quite close to zero. So we have an extremely expansive monetary policy in relation to growth rates. On the other hand, as we saw at the previous slides, I mean, asset prices have been addicted to this central bank stimuli. So we have a situation where we cannot reduce the monetary policy very much without massively dropping asset prices, and the massively dropping asset prices will reduce a credit crunch and will result in a deep economic recession. So most likely we're in a situation where the central banks will not be able to stop growth. I mean, growth will engine on, although we see less fiscal stimulus, specifically in the US, significantly less fiscal stimulus going ahead. I mean, the fiscal deficit will decline from 15% of GDP in 2020 to like 5% of GDP in 2022. So it's a massive decline, like 10% of GDP. But still, we still see, I mean, underlying growth in the economy now, in the private side of the economy that will, I mean, keep on growth. And it will be very hard to reduce monetary policy so much that you actually can reduce inflation without significantly dropping asset prices. So most likely central banks are in a situation that they cannot stop inflation, even if they wanted to. So unwillingly, they are in a kind of inflation scenario, most likely. This is our main scenario. Of course, there are insecurities in this. And that will gradually result in increase in nominal interest rates. On the other hand, because central bank can't reduce the stimulus that much, we will most likely see continuously low real interest rates, which will support the property market. So I have a few more minutes, quite a lot of slides, but I will take just a few of the slides here to have the most important picture in the market. I mean, looking at the transaction market, I mean, it's interesting to look at volumes, but it's more interesting to look at the number of deals and average size of deals. And this is what this is showing. The blue line here is the rolling 12 months average of a number of deals. And what we saw during the end of last year is that, I mean, the transaction market ended up at record levels. Volumes were very high, and volumes kept on increasing actually in January. I mean, volumes always depend on what deals you count. I mean, we count direct deals. We don't count takeovers of listed companies. And then we end up in 2020, 225 billion SEK volume in 2021 and 228 billion SEK volume in January, rolling 12 months. So volumes have increased in January. But what's interesting is that the number of deals actually peaked. And this is interesting. A peaking number of deals combined with a soaring average deal size is very interesting. But that's over time, that tends to be a signal that the market will have a shift in the market. And the most likely shift we have now is that the market will adapt to higher long-term interest rates, adapting to a more stringent and less accommodative central bank policy and higher long-term interest rates, and will probably slow down. So we'll see slower volumes most likely, but still we will most likely have continuous negative real interest rates, which will support the market and keep property very attractive. Also, what we've seen is really soaring residential deal volume, the yellow line here, and also a soaring public property deal volume. So that's a very popular part of the market, where we see that the office market dropped significantly after Corona, from a rolling 12 months volume of approximately 40 billion to like 15 billion. But they are recovering now, and that's also interesting. When it comes to foreign investors, it's very interesting because lots of foreign investors are very interested in the Swedish market, but it's very hard to find deals. And the gross volume is within, or have been within 20 and 30 billion SEK for like 10 years, and it remains there. It was just about 20 billion in January, rolling 12 months. I mean, there are lots of foreign investors, but they very hard to do deals actually. And we see that the number of these are actually declining because values are increasing. And that is because, I mean, it's not lack of interest. It's because it's a very competitive environment in Sweden. Lots of large Swedish, those listed companies, institutions that are looking for deals, and it's very hard to come in as a foreign investor in a market where connections and physical presence is extremely important as well. Office market has bottomed out from low levels. I mean, looking both at number of deals and transaction volumes, the drop in the office market was really concentrated to Stockholm. Stockholm represented the main drop. But what we see now is really that, I mean, the market is recovering, and we see specifically that the rental market is recovering, and we see that there are lots of investors looking into offices. And I think I'll move on a little bit because I mean, office rents are very strongly connected to GDP growth. But the office rents, they most likely, or they did actually bottom out sometime early 2021, and we've seen growth for a year in the office market approximately. So office market has turned around, and that is of course driven by strong GDP growth. Here you can see combination between rolling 4-year GDP growth in Sweden and average rent year-on-year growth for the CBD. It's very strongly correlated, and of course the strong growth in Sweden has propelled the office market, of course. And then, of course, you have the problems with work from home and a large potential for increasing efficiency in the office market and all that. But still, we see a recovery in the office rents. You can also see this when we look at the listed companies, what they actually report, and put that down into each property segment. We look into 40 listed companies and look into their reported incomes, which also includes vacancies and discounts and so on. So rental incomes per square meter. And then you can triangulate that down each property segment, because we follow each property company and we map up their properties really and per segment. And then you can see that the market has really started to swing up when it comes to year-on-year growth rates. Probably this will swing down, but we are not seeing this massive growth rates, but it's mainly probably a reason because vacancies are dropping. But growth rates are bottoming out and increasing. That's our view. And I think I'll end with this graph because we're a little bit short in time, but I think important looking into the market going forward. I mean, it's the property market and the rental market. I mean, when we analyze the property market, we split up the market in 30 property segments. And when we look at each segment, I mean, all of the segments are very strongly correlated to macro factors, but they are correlated to different macro factors. And the rental market is very important now when we have, as we see, an inflation scenario going ahead with a large probability. And looking into prime offices and also the retail market, they tend to be strongly correlated to GDP growth. And specifically, offices in Stockholm are very tightly correlated to real GDP growth. While looking at logistic, industrial, and residential and public property market, they are much more correlated to CPI inflation. And this is very interesting and very important because in the inflation scenario where we have relatively weak growth over the coming 5 years, we expect an average growth rate in Sweden of 1.2%. And that is because inflation in itself actually hampers growth, because inflation is pushing up costs and it's hard for wages to keep up with that and all that, and that's hampering private consumption and so on. In that scenario, we actually expect that these inflation-linked segments will outperform. And that will hamper actually the office market, for instance, over time, because the rental market is more connected to real growth. That's just how that market works. On the other hand, we also see challenges in some of these inflation-linked market because investors have just flowed into this market over the year, and specifically now we see a supply-demand imbalance is approaching, specifically for newly produced rental homes. There we see a massive increase in supply, and that will most likely result in higher vacancies and also hamper rental growth going forward. We see a similar development in logistics, where we see a massive increase in supply, and we actually see that over the last 5 years, actually, rental growth rates have been declining. So I mean, it's still not that easy. I mean, it's you have inflation-linked segments, but you really need to look into these segments, not actually properties that will be able to produce growth in line with inflation. And that then we have some parts of these segments that have challenges in the supply-demand environment. Another aspect here is also that, I mean, you have massive yield compression in these inflation segments over the last year. I mean, for instance, residentials and logistic and so on. While in offices, you basically have the same yield levels for prime offices that you had pre-corona, a little bit downwards in yields, but that makes them very attractive at the yield basis. So overall, I mean, we expect the transaction volumes to pick up in the office market going forward, and that will most likely be driven by listed companies, as we see, because listed companies have had strong value growth, and specifically the listed companies focusing on offices and retail property, they also have value growth, but they have actually been net sellers over the last years. They will most likely, to keep their LTVs constant, they will most likely need to invest more. So more investments there. I think I stopped there, Joe.
Thank you very much, Arvid. Very interesting. A lot of things to pick up on. But before we do that, I'll hand over to Karen, presenting the industry consensus forecast.
I'm going to present the latest consensus forecast from SEPREF. I'm the head of research at Colliers in Sweden and also a member of the steering committee of SEPREF. First, I'm going to talk a little bit about the survey for those of you who are new to this survey. It's a quarterly survey that we started off in 2008 in Stockholm, and it went well, and therefore we extended it to cover Gothenburg and Malmö as well 2 years later. What we forecast is prime office yield and prime office rent for these 3 markets. We have divided the survey into 2 parts. We are making a short-term forecast. It's a very, very short term. It's the end of the quarter, so it's less than a quarter forecast. And also we make a longer forecast, more of a trend forecast for 1 year. And the overall purpose of this survey is basically to improve the market transparency in the Swedish market. And looking at the respondents, it's a clear overweight in property consultants. In the latest survey, 75% of the respondents were consultants, followed by institutions, investment manager, and unlisted property companies. Normally, we have some listed property companies participating as well, but not this time around. So over to the results. This is not the best slide in the universe. This is a picture from the presentation that is actually being sent out to the respondents. But in order to make this presentation a little bit more interesting and understandable for you, I've made a few charts and graphs. So I'm starting off with a short-term forecast for Stockholm. What this chart is showing you is basically all the survey results, so the short-term surveys, from the very start, combined into lines. I love long data series, so I'm very happy when I look at this slide. You have the Stockholm prime rents, that's the blue line, the left-hand scale, and you have the yield, prime office yield, Stockholm, right-hand scale. And if what it shows us is that we've had quite a substantial rental growth over the last years, and also yield compression. If we look at to the right of the chart, it looks like the rent forecast has been a little bit volatile. It's been moving a bit up and down over the pandemic period, and I don't think that really reflects the market. I think it reflects the difficulties to survey the market, because there's been a lack of market evidence over the pandemic period. So it hasn't been easy to say whether rent actually is. But what we can see is that we are back now at a level where we were before the pandemic. It's actually higher. The short-term forecast for Stockholm is 8,300 Swedish krona per square meter per year, and that's actually a top level that we haven't seen before. And if we turn to the yields, it looks like there has been a yield compression throughout the pandemic period, and we are now down at 3.2. And if we look at the 1-year trend for Stockholm, I've made pie charts at the top that describe the latest results, and they show that 40% of the respondents believe that Stockholm prime rents will increase over the coming year. and 15% believe that rents will come down. And if we turn to the right hand pie chart, 32% of the respondents believe that we will have yield compression over the year, and 16% believe that yields will increase. And at the bottom, I've made historic series taking the percentage share each quarter who think that rents will increase, and I've illustrated that with red bars, and the percentage share who thinks that rents will fall, that's the blue bars. And I think what's interesting here is to look at what happened when the pandemic started, how we went from a very positive view with 40% expecting rents to rise, and then it just went down to zero over one quarter. Instead, 80% of the respondents thought that rents would fall. So we went from a positive mood to a very negative. But over the pandemic period, the optimism has come back. So we are now back in a situation very similar to where we were before the pandemic. And if we turn to the yields, the trend is not as clear. And I think that has to do also with it's not very easy to forecast yields. But you can see the trend going from yield compression to 50% expecting yields to increase, and then a little bit wobbly. But now we have a situation where 32% thinks that yield will come down, and as I said, 16% think that yields will increase for Stockholm. So I'm moving on quite quickly, so that we will have time for questions afterwards. So here are the short-term forecasts for Gothenburg, and you can see that Gothenburg prime rents have been increasing gradually over this period from 2010 all the way to today. We are now up at 3,600 in the forecast, and that's the highest level we've ever seen for Gothenburg. Yields, the yield forecast has been very stable for a long time, but for the last 2 quarters, we've seen expectations of yield compressions also in Gothenburg. So the short-term forecast is down at 3.75. And if we turn to the one-year trend, it's quite similar to Stockholm, with an overweight for the unchanged opinion, but 37% believe that rents will continue up in Gothenburg. And if we look at yields, it's a more balanced view, almost the same percentage share expecting yields to decrease compared to those looking or expecting yield softening. And you can see the long-term trends quite similar to those we saw in Stockholm, with this massive change in opinion when the pandemic started. And then looking at the rent forecast, we are now back to a situation very similar to the situation before the pandemic. And Malmö is a very stable market, but rents are picking up gradually there as well. Malmö has a large supply pipeline, or a large development pipeline, and it's been so for a long time. And that's really hindering rents from increasing very much. I think it's interesting to look at the yield forecast. It's been unchanged or flat for such a long time. But now, in this latest survey, we are seeing expectations of yield compression in Malmö as well. But if we look at the one-year forecast, there is a big overweight in the stable outlook, and that goes both for rents and for yields. So Malmö is a very stable market, and it looks like it will continue to be like that. So a quick summary of this. Our survey is indicating a positive view of the market going forward, both in terms of rental growth and yield compression, and both in the short term and in the longer term one-year outlook. So I stop there.
Thank you very much, Karen. We have a couple of minutes here for questions and answers. I encourage all of you in the audience to post your questions in the questions and answers or Q&A tab on your sessions. I'll kick off with a question around inflation. It seems that inflation is once again showing its ugly face. Last time we had significant inflation was in the sort of late 60s, early 70s. Are we looking at a similar scenario for real estate going forward? I'll open up for Arvid and Andreas and Karen and Tiffany if you have any thoughts on that.
Well, I can start off. Well, perhaps not a severe inflation as in the 1970s. The thing with inflation is that overall the global economy overall is what has been over hundreds of years. Actually, we did a research report on this, looking into economic indicators over inflation since actually late 1200s onwards, over like almost like 800 years. And if inflation the global economy is disinflationary, and inflation tend to, periods with high inflation, they always strangles the economy and push down growth, and then inflation falls back. And inflation has over time been extremely volatile, fluctuated between like deflation of 10% and inflation of 20%. and so having this kind of inflation target of like 2%, and then steering the economy based on decimals in inflation, that is in a historical perspective just crazy. Because it's an extremely complex measure. It includes everything, all goods, and it includes supply, and includes demand, it includes the weather, it includes currencies. It's extremely complex measure and hard to. But what we know is that high inflation tends to strangle demand, and then inflation drops back. But we still have periods with historically short periods with very high inflation, and those periods can keep going for 20 or 30 years. So even if we have a trend of declining inflation in the kind of world economy in Sweden over the centuries and over the years, we can still have a period of 10 years with high inflation. But I don't think we will end up in like 10-15% inflation, but it's not impossible that we will have approximately 5% inflation, and that authorities will believe that this is acceptable, and also perhaps because they don't have any option, because they can't stop inflation as it had taken its roots, because asset prices are too vulnerable to tightening. But I think that this is a way to kind of deleverage economy. If you have 5 to 10 years of 5% inflation, and you can keep real long-term interest rates negative, you will have a better debt GDP outlook after 5 to 10 years than you have now. The other option is actually to keep, actually push up the actual real growth rate in the economy. That's the other way of deleveraging. But that is very hard because the high debt levels and high asset prices are hampering growth. And they have been for decades. And the potential growth rates have just dropped, and it's extremely hard to push up growth, because then you really have to do real serious reforms in the economy. And politically, that is extremely hard to do, because what you also see is that this way of stimulating the economy that we said over the last decades, it has really created a weak political governance, because it has really increased inequality, and it has created strange political parties and all that. So it's very hard to do these reforms. So it's I think inflation is kind of the only way out there. But of course, in the long run, I'm sure that the economy is deflationary. It is, but we can still have 20 years of inflation. It will still be a short period of inflation in a kind of historical perspective.
Understood. Andreas, any additions or thoughts?
Well, generally, I just want to repeat what I've mentioned earlier, and I'm not sure if I really 100% agree to what Arvid said, but I think it is really important that we look at what is driving inflation, because that then has an impact on real estate, rents, capital value growth, and the likes. And what we found is that if inflation is driven by strong economic growth, this is positive for real estate overall, very generally speaking, because what high inflation in this context means is that the economy is strong, companies are hiring, are demanding office space, consumers are willing to spend money. So it's an overall upwards trend, and in this context, inflation isn't necessarily a bad thing. I think, and Arvid has mentioned that we are in a very tricky position now, since inflation is not mainly demand driven. It's based on supply chain disruptions, or rather coming from the supply side, and this will be very difficult for central banks to control, particularly when we look at what they've done during the past few years. And the question is, how much firepower do they have left in the pockets?
Yeah.
I agree that, because inflation scenario is not bad for property. A property is a classic real asset, and it's a classic hedge against inflation. And an inflation scenario where you actually have continuously low real interest rates, which I believe is a quite reasonable scenario going ahead, is quite good for actually that supports property. Then of course we have the problems to supply demand balance in different segments and all that could create bad surprises for investors that actually thought they had inflation hedged assets, which make up that over 5 years they didn't have any rental growth and didn't have an inflation hedge. That could be problematic. But on the other hand, I think overall, I mean, inflation is good for property. It's bad for the economy, but good for property.
And I thought your division of the different subsegments of the property market, I think that's a very relevant sort of aspect to this, that not all property types are created equally, and there's differences in there.
Of course, you really need to be selective there when you go into and understand what drives the rental market in each case. So that's extremely big, but that's also thing. I think most kind of cross asset allocators and so on, they think of property as kind of one asset class and so on. And I understand that they have lots of asset classes, so there's no bad thing about that. But I'm a kind of a property nerd. in my view, in Sweden there are at least 30 asset classes, if you call it, or segments in property. So I think you really need to be selective there.
Yeah. Well, thank you. Thankfully, you're preaching to the already convinced, right? We're all property nerds here, one way or another. So you'll have full agreement here. Thank you, Arvid. We have a question here, and I think it's initially for Karen to respond to, but I think there's something more to this as well. And the question is, with regards to the separate forecast, if you ask. Can you discern if there's a difference in expectations between occupiers and tenant representatives?
We cannot really see that in our survey. That's the short answer.
That's a short answer. So we'll broaden the question and sort of rope in Arvid and then Andreas here as well. Have you seen any indication that there is a difference in expectations between sort of the occupiers and sort of the tenant representatives or the sort of the leasing side of the market. Is that something you have any thoughts on?
I can only guess, to be honest, and therefore, I mean, we all are both. We are tenants because we've leased an office, right? But we are also as investment managers covering, let's say, the other side of the spectrum, and therefore, I don't think that there's a clear answer to that question, I'm afraid. And we certainly see the changes in the leasing markets. It's not referring to Sweden only now, but for sure, if we look at the office markets, there is a clear difference between, let's say, the UK, mainly London, and other geographies. For example, in London, where you have commute times of 1 hour, 2 hours, people tend to rather stay at home, whereas in cities such as let's take Munich as an example, where I am based. I mean, it takes me 30 minutes by bike to commute to the office, and I think from the overall understanding of the markets, I would say that smaller cities, the difference between the views of tenants and tenant representatives, investment managers, might not differ that much, whereas in other markets, but I'm just guessing, in other markets there could be a bit more difference, yeah, but only guessing and trying to find some arguments.
Well, I think one of the conclusions from all your presentations here is that we're sort of at a cusp of something that might be secularly different from what's been the case of the past 10, 15 years, either from the inflation side or in terms of the various asset classes within real estate. So it's going to be an interesting market going forward in all aspects of the real estate market. We have a couple of minutes left. And one of the big, to paraphrase Andreas here, one of the big elephants that might be even a mammoth is geopolitics, which tends to be sort of either brushed to the side. But do you have any thoughts on that and perhaps its interaction with inflation and risk premia and stuff like that?
Oh, geopolitics is a tricky topic, and let me phrase it that way. We've always seen that geopolitical events have driven the investment markets. Just think about crises in North Korea, for example, 2013, 16, and don't know when the last one was, but following crisis in North Korea always led to an increase of South Korean capital being invested abroad, either in the US or in Europe. And there was always a gap of 6 to 12 months. So there's a quite strong correlation. The same is true for crises in the Middle East. There's also, let's say, oil price related correlation to investments. So money coming from Middle Eastern countries flowing into Europe or the US. So there are not only bad things, and don't get me wrong on that, coming out of geopolitical crisis for the real estate markets, because this also is often a push for international capital flows around the globe. I mean, Brexit, to mention, the obvious European one, has also led to a redirection of capital into Europe. I think this is certainly also a big factor that impacts the markets significantly, aside from, let's say, ESG, which is the other elephant or mammoth in the room.
All right. Do you have any additions to that, Arvid, or any thoughts? I mean, the obvious impact is that the Almedals week might be a bit more contentious this year.
I mean, not that much actually, but I think we are coming from a unipolar world dominated by the US to more a world dominated by a multiple of power. So I think these tensions is something we just need to get used to, and that's kind of how it used to be. I mean, Europe is lots of countries in Europe close to each other. We've had thousands of years, 3,000 years of almost constant war, and sometimes we've had 50-year periods with peace and so on. But I think what we see going ahead is probably we have to get used to a little bit more geopolitical tensions, because that's the type of phase we are in. I mean, the US and China are now two kind of major players on this arena, while 15, 20 years ago, the US were more fully in power, both economically and militarily and culturally also. So, and I think Russia is kind of the wild card to some extent, strong militarily but weak economically and so on. So I think this is something we need to get used to, and that's also one of the pictures, of course, in a scenario with higher inflation. I think because this is something that drives and drives inflation, of course. Gas prices is the latest issue, of course, in Europe now with Russia and their control of the gas and so on. So this is something that put kind of perhaps it's not leading to drop in globalization, but it hampers at least the growth in globalization, and it reduces insecurity in supply lines, which make companies kind of reshoring, and I mean, because now we really see that more and more companies see the supply. They look into the security in the supply lines to much larger extent, just after the COVID and after this and all that, because we know how expensive it can be and how much profit you can actually lose when you cannot deliver.
Okay, thank you very much. We'll sum up here. I would like to thank Andreas, Arvid, and Karen for your presentations. Very, very useful. A lot of food for thought. So once again, on behalf of SEPREF and Samhällsbyggen, I thank you very much for taking the time. Tiffany, do you have any things you want to say before we wrap up?
I want to thank you as well, Jan, for moderating the seminar and for the good discussion that has been had. And I want to thank all of the speakers for their excellent presentations and good knowledge that you have spread regarding the trends going forward that we see in 2022. There are a lot of elephants in our room we have learned during this hour, and I hope that we can find ways to handle all of them. Thank you everyone for joining, and thank you everyone who organized this. Thank you, Frederick, as well, for organizing this and helping us. Have a wonderful day.
And you. Thank you very much.
Bye.
Cheers.
Bye.
Bye-bye.
Bye.